Physical gold, antidote against the ongoing global debt crisis. 1st of August 2012. Ladies and gentlemen, my name is Claudio Grass and I'm the Managing Director of Global Gold in Switzerland. Within the next 40 minutes, I would like to provide private and institutional investors a glimpse into our point of view because we are convinced that today's situation differs greatly from that during recent crises. For this, we rely on the economics of the Austrian School of Economics. The last centuries have been dominated by the theories of John Maynard Keynes, which is based on centralized government structures as the whole of the world. Therefore, I would like to ask you to forget all about the teachings of Keynes in regards to his monetary theory. I hope you will approach my presentation with the needed frankness, which requires the ability to think independently and to draw logical conclusions. Let's take a closer look at the major features and the respective differences between the theory of Keynes and the Austrian School of Economics. John Maynard Keynes turned the whole world upside down with his argumentation that savings is not a premise for investments. On the contrary, it is a burden for economics. His opinion was that wise and clever planners at the central switch point would know more and that they could correct macroeconomics imbalances by manipulating market signals. That's why, in most cases, he saw an easing of lending as the only solution. This theory implies the existence of a wise government who has a large influence at every level of economics. Freedom was not a subject which kept Keynes busy. As we can see, this system enables a massive centralization of power. In this context, Lord Acton stated it best over 150 years ago: power corrupts and absolute power corrupts absolutely. The Austrian school, however, stands for private ownership, free markets, healthy money, and a free-thinking society. It enables us to understand the economy under consideration of the unpredictability of human actions. No one, really no one, can foresee the future. The Austrian school takes into consideration the very important role of which people's decisions have on all transactions and explains how things are put in order despite the apparent chaos of individual actions. Conclusion: the Austrian school offers the strongest defense. Striving for personal and individual happiness is key. The basic for such a society and economics is built on market money, which can be chosen by people themselves, free of any constraints or enforcement. As history shows us, such an item has to possess the following features. It has to be comparable, dividable, it has to be rare and easily transportable. Gold and silver accomplished these features the best, and this is also the reason why these metals have been the top medium of exchange over the past 5,000 years. Gold and silver have an inner value and are not dependent upon promises of debt redemption by a third party. That's why I believe that the central banking system is ultimately the root of all evil. It's wrong and insane that we stick to a monetary paper system, which is based on the promise that the accumulated unpayable debts have to be redeemed by the actual and future generation via taxes and inflation. Furthermore, it is a fact that all past fiat systems have ended up in hyperinflation, having built the basis of wars and destruction. The actual system is only the longest lasting experiment so far, and at this point we don't have anything to even compare it to. So let's have a look at the US true money supply versus exponential growth rate. Here is the one chart which defines the background to all events in the coming years. It is the Mises Institute True Money Supply for the US dollars. The true money supply consists of cash, checking accounts, and no notice deposit accounts, as well as a few other minor cash balances. It represents the actual cash and electronic cash in the system that is instantly available for purchases of goods and services, and this chart goes back to 1959. The dotted line is the exponential growth trend, or in other words, the maximum rate of growth that can continue forever. In this context, I usually like to quote Kenneth Boulding, economist and social scientist, who once said, Anyone who believes exponential growth can go on forever in a finite world is either a madman or an economist. This trend was valid until mid-2002. However, since then, the true money supply has accelerated at a faster rate, telling us that true money supply growth entered a hyperbolic phase when the Fed eased rates in the wake of the dot-com collapse. In other words, the true money supply is already hyperinflationary. As you can see on this slide, in January 1946, the funded debt stood at 260 billion. In June 2012, the debt stood at 15,700 billion US dollars. And when we look at the time periods between 46 and 66, the yearly average increase was 3.10 billion. Between 66 and 86, the yearly average increase was 74.75 billion. So already a 25 multiplicator versus 1946 to 66. When we look at the next 20 years between 86 and 2006, the average increase per year was 304 billion. So already 99 times the average yearly increase between 46 and 66. And now what we can see since 2006 is a yearly average increase of 1,199,000. So that leads to a multiplicator of 370 times average the yearly increase between 1946 and 66. Funded and unfunded government debt in percentage of GDP. So the explicit public debt, or so-called funded debt, equals the official governmental debt, for example, secured debt payable from the current revenue of the government. The implicit government debt represents unfunded liabilities and describes the difference between outstanding claims, public spending, and expected payments revenue. It covers the funding gap between all future payment obligations and the expected projected governmental revenues should the current policy remain in place. Included are governmental promises to pay, especially in regards to pension and pension right claims. So how does one finance debt? As we have seen before, by lowering the interest rates. On August 15, 1971, President Nixon closed the so-called gold window, refusing to let foreign banks redeem their dollars for gold, facilitating the devaluation of the US dollar, which had been fixed relative to gold for almost 30 years. This action was a direct reflection on the fact that the US was actually already bankrupt at that time. In 1973, a system of floating exchange rates was implemented, and by doing so, they opened the floodgate for a never-before-seen creation of money and credit. This led to a situation within the United States where inflation rates went through the roof and where Paul Volcker, at that time the chairman of the Fed, had to increase interest rates up to almost 20%. Inflation was as high as 13% by the end of the 1970s, but the official rates for short-term bonds were only at 8%. Therefore, the real interest rate at that particular moment stood at a negative 5% per year, and as you will see later on in this presentation, gold and silver prices increased enormously. However, the difference in terms of increasing interest rates back then and now is the US total debt level. As you can see, in the 80s, the debts of the US were relatively small in comparison to the debts we have today. Since then, the US has become the world's biggest debtor nation and making any increase in interest rates unsustainable, as we can see on this particular slide. So the blue line, total debt, and the green line represents the federal fund rates. And here we can see from 80 basically the way it moved up, how much it increased the total debt, and what happened to the interest rates. As we have seen before, not only the US, but the whole world is currently facing the highest level of public debt in times of peace. The far-reaching consolidation of public budgets does not seem to be up for discussion. The necessary grave cutbacks are being postponed, and the policy of muscling through is cheerfully continued. It is logical that you can't fight over indebtedness by adding even more debt. It is important to underline that the driving forces of economic health are savings and investment, not consumption and debt. According to the Austrian School of Economics, every act of consumption has to be preceded by production first. Debt is nothing but consumption brought forward, which will then not take place in the future. There does not seem to be any painless therapy of these problems. We at Global Gold believe, therefore, that gold is an effective medicine. We don't expect that interest rates will be pushed up anytime soon, and that central banks will keep on flooding the market with new paper money. As a consequence, we will see a negative level of interest rates, and this will be one of the key drivers behind the rising price of gold. Here you can see the official unemployment rate of the industrialized nations in total. According to Ryder, the global unemployment rate amounted to 196 million people by the end of 2011. The forecast assumes that in 2013, 207 million persons, or 5.6% more people, will be without employment. In this context, it is important to see that these are official statistics, and who you can give credit to or not, it's up to you. Last but not least, here we can see a slide provided by Ferdinand Lips and Chuck Truxler from their book Money, Gold and the Truth, which reflects how stable the British consumer prices were under the gold standard since 1661. Prices were not higher in 1914 than in 1961. However, it's obvious to see that we have a problem since 1914. This chart shows the clearly intact downward trend of most currencies vis-à-vis gold. The equally weighted currency baskets consists of US dollar, euros, British pound and Swiss franc. As you can see, the Swiss franc has lost so far only 90% of its purchasing power because Switzerland used to be for the longest period on a quasi-gold standard, until it was decided by the parliament in November 1996 to decouple the Swiss franc from gold. The reason for that is because Switzerland joined the International Monetary Fund in 1992, and under its laws, gold does not qualify as a monetary reserve. François-Marie Arouet, or better known as Voltaire, who has been a witness of the so-called Mississippi Bubble, another fiat money adventure established by John Law in France around 1720, stated once, "Paper money eventually returns to its intrinsic value, zero." We fully agree with Voltaire and have little reason to believe that the downward trend should subside in the foreseeable future, which is why we stick to our positive assessment of the future gold price development. Let's have a look at the gold price increase during the period 2002 to 2012. Here you can see the prices in US dollars, euros and Swiss franc. The gold price has risen from US dollar 278 at the beginning of 2002 to US dollars 1,590 by middle of July 2012. A clear and pronounced increase of 471%. Gold in euro from 312 euro to 1,297 euros, an increase of 316%. Gold in Swiss franc from 460 to 1,558, an increase of 238%. So, gold is the barometer that indicates that there is something wrong with the fiat currency, otherwise it wouldn't go up. This slide reflects the relative strength, or better said, weakness of each currency in which gold is quoted. That's why gold increased in US dollars the most, because it is reflecting the biggest distrust in this particular currency during the past 11 years. So here we can see the gold overall supply in percentage, the so-called stock to flow ratio, most important reason for monetary relevance. So here we can see jewelry total reserves in stocks 84,000, which reflects 50% of the total stock. Private holdings 31,000 tons and 19%. Central banks reserve 20,000 tons and represents 12% of the total stock, and others 33.6, which equals 19%. So total reserves on stock in tons is 168,000, and we have approximately 2,600 tons additionally gold supply coming on a yearly basis, which reflects 1.5% of the total stock. So in contrast to other commodities, the discrepancy between annual production and total available supply for gold and silver is enormous. This is called a high stock to flow ratio. The aggregated volume of all the gold ever produced comes to about 170,000 tons. This is the stock. Annual production was close to 2,600 tons in 2011, that is the flow. Dividing the former by the latter, we receive the stock to flow ratio of 65 years. We therefore agree with the conclusion of Ronald Stöffele that gold is not precious because it is scarce, but because the opposite is true. Gold is precious because the annual production is so low relative to the stock. Gold has acquired this feature over centuries and cannot lose it anymore. This stability and safety is a crucial prerequisite for the creation of trust. And it is what clearly differentiates gold and silver as monetary metals from commodities and the other precious metals. What we can see here is that the central banks became net buyers. Even the central bank seems to remember that gold is money. Gold is pushed back into the monetary system again. Do you see a trend here? The world central banks became net buyers of gold for the first time in 2010, after they were previously net sellers for many decades. During 2010, the world central banks bought 87 metric tons of gold more than they sold. The gold supply by official sector sales fell from 545 tons in 2002 to a negative 440 tons in 2011. For many years now, central banks in the West have been the sellers, whereas especially countries in the Middle East as well as emerging markets such as Mexico, Russia, Turkey, South Korea, but especially China and India have become the buyers. We at Global Gold expect that this trend will continue with further acquisition by emerging market central banks and no significant sale by those in advanced economies. Here we can see the demand side and the clear shift visible. So the dark one is technology. Here we see jewelry, and the pinky one is the reflecting the investment side. So this is a combined overview of the three gold demand forces: technology, jewelry, and investment. So what this tells us? To summarize the facts we provide here, the gold supply-demand situation has mainly been influenced by gold investment demand, including official sector demand. With all other variables, they are relatively stable compared to that of the gold investment demand. In any attempt to predict the development of the future gold price, it is important to understand this gold investment compound. Here we can see from roughly 9% going up to almost 40%. The past decade was characterized more strongly by deflation fear than inflation fear. One might assume that investors didn't buy gold as an inflation hedge, what gold is actually famous known for. People bought precious metal as a hedge against all sorts of crises: political, financial, economic, currency, geopolitical, etc. If one assumes that these crisis scenarios are still in place and that none of these crises have been solved, or if one even assumes that these crisis scenarios have even grown closer, bigger, or more numerous, and the reason for having a crisis hedge are becoming more convincing every day, then one might expect that gold investment demand will increase and will drive prices higher. In a world long on potential crises and short on any sustainable solutions, we are convinced that it is the right thing to do to stick to gold, and for that matter, have to continue to buy more gold for quite some time to come. This is the gold investment demands 2002 to 2011, isolated in this picture. So an increase of 366%. So gold investment demand has changed the most over the past 11 years, both in absolute and relative terms. It changed from 352 tons in 2002 to 1,641 tons in 2011, an increase of 1,289 tons, and it changed from 10% of the total demand in 2002 to 40% of the total demand in 2011, an increase of 30 percentage points. So, is gold in a bubble? So this slide shows you the yellow line is reflecting the bull market 1970 to 1980, and in blue you can see the actual bull market since 1999. So history teaches us that every bull market ends in euphoria and excess. This slide is comparing index-based the bull market between 1970 and 80 versus the actual bull market since 1999. The yellow line shows the bull market starting in 1970 when gold stood at $41 and went up to $850 by 1980, which represents a 20 times multiplicator. Very interesting to see is that within the last 6 weeks before the crash, the gold price doubled. Notwithstanding the above, I would like to underline that gold was pushed out of the monetary system by the end of 1980. As we have seen before, gold is being pushed into the system again because of the ongoing purchases by certain central banks and because of the fact that the investment demand for gold in general has increased tremendously. Therefore, we are convinced that gold will play a key role in the future monetary system again, and prices will therefore increase further because the value of all the fiat paper money will depreciate due to ongoing exponential expansion in true money supply. Interesting is also the fact that in 1980, 23% of the world's total assets were parked in gold at the price of $850 an ounce, and 14% in silver based on its highest price of $50 per ounce. At the end of September last year, gold reflected only 3.6% of the world financial assets at the price of $1,421, and silver stood for 0.7%. These are facts that show that the upside potential of physical gold and silver is still tremendous. So to conclude, we don't see a bubble in gold, and the only similarity to the situation in 1980 versus today is that we are again confronted with a possible extremely dangerous conflict in the Middle East and Iran in particular. The Iranian banks were kicked out of the SWIFT system a few months ago and are now trading oil and gas with India in gold. The last time another country tried to bypass the US dollars was Iraq under Saddam Hussein. I'm convinced that this led to the US invasion, which has been justified to the Western world based on evidence which turned out to be all lies and rumors without any substance at all. Therefore, it is obvious that you can finance wars as long as you have the ability, power to print money into existence based on nothing than thin air. Percentage of dollar backed by gold. So the graph on top of the slide is illustrating that in the US at the moment, with the current gold price of 1610, only 16% of the monetary base is covered by gold. In spite of the 11 years of bull market, this is only slightly higher than at the time of the absolute low in terms of gold cover of 11% in 2001. Do you see the high after the end of Bretton Woods in 1980? When 168% of the monetary base was backed by US gold reserves? The red line is showing the average coverage during the past 40 years has stood at 34%. The shadow gold price reflects a price level if all the paper dollars would be backed by gold. So even here we can't see a gold price bubble. To cover the monetary base, gold should go up to $10,062. And here you see the comparison, 1971, 18% coverage ratio when the gold price stood at 41. What about the ratio US debt and value of gold reserves? Today, only 2.4% of US government debt is covered by the US gold reserves, if any. As per Ronald Stöffeli from Erste Group Research, this is substantially below the long-term average of 4.9%, with the red line. If the gold price were to double or the government debt were to drop by 50%, which is rather less likely, the coverage ratio would only match the long-term mean. Only at the price of about $16,000 would the ratio reach the highest of 1980. In other words, long-term bull markets never end around averages, but always set extreme values vis-à-vis other asset classes at the end of the trend. This supports our argument that gold is still attractively valued and that the gold price has not entered into its final trend acceleration phase yet. What about Dow Jones and the gold ratio since 1900? So this is another slide from the famous gold report of Ronald Stöffeli, Erste Group Austria. The Dow Gold currently stands at 7.8. The ratio is currently above the long-term median of 5.8. This means that gold is still relatively inexpensive in comparison with the Dow Jones index. However, it is not dirty cheap anymore, but as mentioned before, bull markets tend to end in euphoria and excess, which is why a substantial lower ratio is expected. In 1932, the ratio was 2, and at the end of the last bull market, the ratio was 1.3. Therefore, Ronald Stöffeli, as well as we at Global Gold, expecting that the values of 2 might be reached again and as a result of the secular bull market. Under this assumption of a constant Dow Jones index, gold would therefore have to rise to US dollars 6,200 per ounce. So here I'm showing you the Exeter pyramid with the answer what's happening in a deflationary scenario, that deflation leads to an improvement in monetary quality. In a deflationary depression, liquidity flow from the higher part of the pyramid downwards, amid falling willingness to assume risk. Philip Barton describes credit in his book Safe Haven, A History of Gold, as slumbering mistrust. Creditors try to sell the continuously falling number of liquid assets and heave for the lower assets classes as a result of their rising risk aversion. At the bottom end is gold. Since gold does not hang on any form of IOU, it is the only alternative to paper money and is thus at the bottom of the upside-down pyramid. As we can see in monetary history, during a period of profound deflation, the investment focus shifts from capital growth to capital preservation. Deflation thus always comes with falling confidence in the perceived root cause of the crisis, such as government, banks, speculators, and their rating. Therefore, the purchasing power of gold gains also within a deflationary scenario. Let me quote John Exter, famous American economist, Vice President of the Federal Reserve, New York, member of the Mont Pelerin Society, of the Council of Foreign Relations, which is quite an interesting combination, and of the Committee for Monetary Research and Education, as well as founder of the Central Bank of Sri Lanka. He has been the creator of the Exeter's pyramid, also known as Exeter Golden Pyramid or Exeter's Inverted Pyramid. Quote, so the bottom line for the world economy does not look good. You can do much to protect yourself. Go down the pyramid, get liquid. Federal Reserve currency notes are at the very bottom of the paper part. Hold enough to get through this current liquidity squeeze when banks might close and cash will be king. Treasury bills are good too. They earn interest, but you cannot spend them in the supermarket. Here we might add that he made this statement in the 50s, so I personally would skip the treasury bills because this is the biggest bubble I can see. So he goes on saying, but the best asset of all, whether in inflation or deflation, will be gold at the base of the pyramid. Accumulate what you can of it, either above the ground, like coins or bullion, or in the ground, like mining shares. In summary, an increase in prosperity and growing confidence would then boost willingness to assume risk again, causing a gradual inflow of liquidity from the gold sector into the higher segments of the pyramid, and a new cycle starts. Deflation therefore means an improvement in monetary quality, whereas inflation means an increase in monetary quantity. A safe, convenient and efficient way to buy, store, sell and or deliver allocated bullion gold, silver, platinum and palladium bars and coins in Switzerland. And most important, outside the banking system. So 10 reasons why global gold is 100% different. The aim of us is to cover the important details which will make the difference in the case of crisis scenario. First of all, we are a 100% non-banking solution. So if the banks will be freezed or stock exchange will be closed, we don't care because it won't affect us. We don't buy, sell from two banks, and so we are 100% non-banking solution. The customer owns its metals under 100% direct and unencumbered ownership. So this is a key point you always have to take into consideration should you invest in physical metals. Our program is free of small print cash settlement clauses. So once again, a cash settlement clause is basically a clause which offers certain institution, instead of paying in a crisis scenario, instead of paying physical metals to the customer, that they can pay him out in cash. And this is definitely what you are not looking for if you are investing in precious metals. So we don't have a cash settlement clause. We are 100% offering high security storage locations. For the time being, we are offering it in Zurich and Hong Kong, and within the next few weeks, we will also offer high security storage in Singapore. So 100% the metals are insured and audited. 100% physically stored investment grade bullion coins and bars. And I think most important when it comes to that, we buy from the beginning the metals in the format of your choice. So if you want to buy Kruger or Maple, we go out into the market and buy on behalf of you the Krugers and the Maple leaves. So in the format of your choice, so that whenever you basically would ask for a delivery, that we can do it without any delay. So all the metals are 100% deliverable at any time. So no additional minting down. So all the metals are there and they are fully yours. So you can trade, sell and buy 100% tax-free, even when it comes to silver. So only if the metals are leaving our setup at the tax-free zone, then you would have, for example, on silver, you will have to pay 8% VAT if you pick it up here in Switzerland, or it's up to the VAT regime of the respective country we would have to ship in based on your instructions. But otherwise, you can buy, sell gold and silver tax-free. So we are offering 100% competitive pricing. So we buy at the institutional level, and we are 100% Swiss, And I think even when it comes to property rights and to Switzerland as jurisdictions, in terms of property rights, we believe that operating under Swiss law is still a huge selling point. And because of our decentralized political system based on federalistic structures, we also consider still the place to store precious metals, the safest place to store precious metals for the time being, still in Switzerland.